Ladies and gentlemen, good day and welcome to the Q1 FY23-24 earnings conference call of the Karur Vysya Bank. We have with us today the management team of KVB represented by Mr. Ramesh Babu, MD and CEO, Mr. Natarajan, President and Chief Operating Officer, Mr. Ramshankar, CFO, Mr. Dolphy Jose, Group Head, Consumer Banking, and Mr. Srinivas Rao, Company Secretary and Compliance Officer. As a reminder, all participant lines are in a listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then 0 on your touch-tone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. B. Ramesh Babu, MD and CEO, to take us through the highlights of the quarter gone by, after which we will open the floor for question and answers. Over to you, sir.
So, good evening to all of you. On behalf of Karur Vysya Bank, I welcome you all to our bank's earnings call for the Q1 financial year 24. I am pleased to mention that bank continues to demonstrate its consistent performance in terms of growth, profitability, and asset quality for the first quarter ended 30th June 2023. You will be glad to know that our performance in terms of asset expansion, margin, RoA, delinquency is in line with our guidance. I am sure you will not disagree if I say that the outcome is on account of our conscious efforts, which we were explaining to you in our earlier calls. All of you would have gone through our detailed presentation on our Q1 numbers. I would like to share some of my thoughts on the performance of the bank during the quarter and our guidance for Q2. Our total business grew by 4.88% during the quarter and reached a level of 1,47,671 crore. Advances grew by 4.58% during the quarter, and it's an inclusive growth across business segments led by commercial and agriculture, clocking 5% each. Our continued focus on MSME in the metro and urban locations and gold jewel loans in rural and semi-urban locations supported the growth. Retail grew by 4%, and majority of the growth has come from mortgages, both residential as well as non-residential. Our focused efforts on the distribution and benchmarking of our products to market supported operating teams to garner more business under these segments. Though there were sizable disbursements under corporate, as we consciously let off certain low-yielding borrower accounts, the growth looks to be lower at 2%. The overall growth is tad above on our annual guided growth of 14%, and the trend would continue, and we do not see any challenges. Our deposit growth was at 5.32% during the quarter, and term deposits and CASA deposits were grown at 6% and 4.32% respectively. Though accretion to some extent was aided by return of 2,000 rupee notes, we are sanguine that the growth momentum would continue and support the asset expansion. We had highlighted about our liabilities acquisition team. Out of the planned resource of 1,300, we have onboarded 425 resources during the end of first quarter, aggregating 905 resources. The outcome from the acquisition team would be visible from the second half of the year. So in the Concall, our colleague, so Mr. Dolphy Jose is there later, so he'll be also explaining what are the things happening in that particular wing. Net interest margin reduced by 18 basis points on sequential basis during the quarter at 4.19%. We had indicated in our last call about the expected compression in NIMs during the first two quarters and would be in the range of 4% in the next quarter too. While cost of deposits has gone up by 35 basis points, yield on advances increased by 14 basis points during the quarter, resulting in a compression of 21 basis points. Based on our historical pattern of renewal of deposits and fresh deposit accretion, we expect that there will be further increase in the cost of deposits to the extent of around 20 basis points in the second quarter, assuming no change in our deposit rates. Considering available market liquidity, and fall in bulk deposit rates, we had reduced our interest rates on special deposits by 20 basis points in June 23. Yield on investments has gone up by 8 basis points during the quarter, and it is estimated to go up by 10 basis points in the next quarter. We expect 10 basis points increase in the yield on advances during the second quarter because repricing of loans on account of MCLR will be there. Considering all these factors and without taking into any policy rate changes, we expect to maintain NIM in the range of 4% for the second quarter. We have achieved an RoA of 1.53% in this quarter. In spite of reduced margin, our business growth, fee income, lower credit cost, and recoveries in written-off effects continue to support us to keep our RoA at 1.5 levels. Our cost-to-income ratio was at 47.29 for the current quarter, which is well within our guidance and sequentially higher over March quarter. This is due to lower recovery in technically written-off accounts and lower write-back of depreciation on the income side and increase in employee cost on account of one-time performance incentives, which is annual payout of 46 crores. Last year, this was done in the month of July. That's why it has gone to the second quarter. This time it has come to the first quarter. Otherwise, it is an annual phenomena. Our normalized employee cost would be in the range of 300 crores per quarter. As guided earlier, the ratio would be in the range of 45 to 50% for the year 2024. Our slippages continue to be under control, and our gross slippages for the quarter is less than 1%, which is as per our guidance. We continue to have negative net slippages taking into account recoveries from the written-off accounts this quarter also. So all of you would have seen that more than 7-8 our net slippages are negative. Our SMA 30 plus of entire loan book at the end of the quarter continues to be at less than 1%. Though it has increased sequentially compared to last quarter, we do not foresee any alarm as it tends to be elevated during the first quarter of the year. We are confident that we will continue to keep the ratio below 1% as guided in our earlier calls. Our efforts on recovery of technically written off book is continuing to yield results as we have recovered a sum of 58 crores during the quarter. Due to lower slippages, recoveries and written off, our gross NPAs have moved to below 2%, and we expect that we will continue to maintain at below 2% levels. For the quarter under review, we have provided a sum of 137 crores towards NPA migrations, standard assets, and prudential provisions. We estimate that credit costs for the current year would be in the range of 75 basis points as guided. We have also created a floating provision of 25 crores as a prudent measure. Our net NPA has come down to 0.59%, and we would continue to maintain our net NPA at less than 1% of our loan book. Our standard restructured loan book is further reduced to 1.33% of our loan book, and we hold a provision of 54% on the standard restructured book. Our CRAR continues to be robust at 17.67, providing us a comfortable headroom for growth. Our liquidity is well managed, and the CD ratio is at 83%. During the quarter, we opened 9 branches and opened 1 digital banking unit at Chennai, and another 38 branches will be opened during the current year. Our new initiative of KVB Smart under commercial banking business has started functioning from Coimbatore, Chennai, and Hyderabad locations during the quarter with a team size of 8 RMs. Our business performance highlights are given in our presentation, which you would have seen. We have been consistently improving our performance over a period of the last 2 years, and the trend is continued for the first quarter also. Our team is mindful of the same to take it forward, the confidence of taking it forward. Our endeavor would be to focus on sustaining RoA above 1.5% levels going forward. I am grateful to all our investors, analysts, and stakeholders for the confidence and continued support which we will reciprocate through our better performance in the days to come. Now, I will be glad to respond to your questions. Thank you.
Thank you. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Ladies and gentlemen, a reminder, if you wish to ask a question, please press star and 1. Our first question comes from the line of Prabal Gandhi with Ambit Capital. Please go ahead.
Yes, thank you for the opportunity. Am I audible?
Yeah, audible, Prabal. I think some more clarity, if that is there, that will be good. Please go ahead.
Is it better now, sir?
Absolutely better. Now you go ahead, please. Thank you.
Thank you, sir, and congratulations on a good quarter.
Thank you. Thank you.
So my first question is on growth. So can you update us on the performance of the non-branch channels? How are they doing?
So non-branch channel, when you are talking about on the liability side or asset side?
On the asset side, meaning co-lending, Neo, KVB Smart.
Yeah, fine. Absolutely. Now, Neo is doing pretty well. Actually, if you can look at it, so last year they grew by around 2,000 crores, and this year also, more or less, they are 1,800 last year, and it's 150 crores, something like that. They have been growing, and they are expanding to few more geographies also. So that way, Neo-wise, it is not an issue. And we earlier last year, I was mentioning that we made an experiment with Neo by creating a new home loan branch at Hyderabad, and subsequently similar branch, home loan dedicated branch, was opened at Bangalore, now at Chennai, and later they will be opening at Bombay. So these branches started booking business. That Hyderabad branch has already started working well, and all more or less around 100-200 crores already outstanding they have got in the last 8 months. So other branches also, they are in the pipeline, they'll work well. In addition to there are other products what all are there like LAP. So they are doing well with the new geographies adding. So Neo will be on track. Now coming to the co-lending, if you look at it, our co-lending arrangement is there with the Chola and a few other players which is in the pipeline. But the main flagship program is Chola, which is more or less around 750 crores is outstanding now. That's going on pretty well, not an issue at all. So other 2 to 3 smaller players also, we are working on that. Maybe in this quarter we may be able to clinch few of them. Now coming to the KVB Smart. So initially we are taking the people, and as in my inaugural message I told, so we are working with Coimbatore, Chennai and Hyderabad, these 3 centers. Already 8 relationship managers and a few more credit people, we have already taken them on board. Now these people, they need to get adjusted. So we are reasonably confident with the new experience what we have. The KVB Smart initiative also will work well. And the another thing is we can create a linkage between the Neo as well as the KVB Smart, because Neo handles the LAP and other products, and Smart handles the working capital. If these same customers, if other side working capital, we can handle this. So there will be lot of synergy will be both of them. So that way, all 3 what you mentioned, they are on track and doing well.
And these all 3 put together, how much they would be contributing in the loan book right now?
Loan book, if I can say, Neo will be around 450. No. This quarter you are talking the total loan book you are telling.
Outstanding on the loan.
The total loan book, Neo. Actually, 1,000. No. Neo itself is higher, na? Neo co-lending. No. All three together is asking. So all three together, co-lending is 750. Neo will be how much around? 4,500. 4,500. Neo this one, and KVB Smart just started. It is in 2 digits.
Okay, so meaning all put together 5,500 crores.
Around that area. Correct. You are right.
Okay. And just one question here. So how are you controlling risk here? Because Neo, KVB Smart, and all these are done not from the branches, right? So there would be some element of risk involved here, right?
No, I understand. These are actually the accounts are there in the branch finally. So next thing is the documents are also coming to the branches only, placed in the branch, and we have a perfect system of these onboarding and checks and balances, audit and external audit, internal audit. All these things are there. Not only that, our risk management department also continuously they review what is happening there. So that way, in all these cases, we have placed checks and balances. Co-lending is concerned, it is absolutely within the central office we are doing. So KVB Smart just started all the processes, what all need to be done. So we have formulated here. Based on that, we are going ahead. Neo is more or less stabilized that way, and we are doing audits and all that way, audit reports. We are getting a better control on that.
Yeah, Prabal, in addition to that, as far as Neo is concerned, the credit policy for the Neo or the other branches are same, number one. And number two is they are also using the same loan origination system. Whatever the underwriting standards which are defined for the digital lending, same thing is applicable. In that way, there is no difference either in the underwriting or in any of the other processes. Only sourcing is a differentiator.
And so in previous calls, you also mentioned that your aim is to increase branch per loan per month to 2 versus what it used to be a quarter. Now, what is the your aim is to have branch per month per number of 2 loans per branches per month versus it used to be a quarter ago, right? So what is the progress there?
I am unable to recollect. When did I say that 2 loans per branch?
No, meaning every branch per quarter used to do 2 loans earlier, and your aim was to increase this to 6 per quarter.
No, this is a general focus which we are providing to the branches for the overall improvement.
But I can fairly recollect, Prabal, in any of the calls I made this statement.
Okay, not a problem. Okay, on the margin side, so can you guide us to what is the pricing trend in the SME segment right now?
SME segment, majority is the commercial if you look at it. So it ranges between 9.5 to 10%. Average yield itself is between 9.5 and 10% we are getting it, commercial. So our retail is concerned, that is also around 9% odd, and agriculture is also around 9% we are getting it. It is slightly lower in respect of corporate. That is the reason in the inaugural when I was mentioning that. So I clearly mentioned that consciously this quarter as well as last quarter, we allowed few of the big accounts or where the low yielding accounts are there. When the reset is due, we allowed them to prepay. Because by prepaying them, overall our margins have improved, otherwise, so it is not adding anything to the margin. So overall that way we are focusing on that. You would have seen that 9.69, 14 basis points we could improve the margin over last quarter.
Got it. Understood. Okay. Okay, sir. Thank you. If I have more questions, I'll come back in the
Please. Thanks, Prabal. Thank you. Yeah.
Thank you. Our next question comes from the line of Pranav Tendulkar with Rare Enterprises. Please go ahead.
Hi, sir. Sir, can you just highlight factors that will actually affect NIMs going forward, and what is the outlook for the year?
Sorry, Pranav. That is there, Pranav. We are unable to hear you. Understand the issue.
Hello. Can you hear me?
Yeah. Please tell me.
Yeah. So I'm just asking, what are the various factors that you can visualize that will affect NIM going forward, and what will be the guidance for the year?
Okay. Understood. Yeah, factors in the sense that, you see, when we did a ballpark working on the usual pattern of the deposit renewals, in which bucket they will be coming and all based on our historic experience. When we worked on it, we found out saying that, so around 20 basis points, the cost of deposits may go up because one of our flagship product, which is a 444 scheme, 4 and 44 days, where a lot of inflows are coming. So there, consciously, when these 2,000 rupee notes was going on at that time, when we saw an inflow, we have reduced the rate of interest by 20 basis points. But despite that, I know there is a small dip in that bucket, but overall the flow is still there. With these things, what we feel, the cost of deposits can go up by another 20 basis points. Likewise, when we look at our MCLR portfolio, so what all the portfolio which is coming up for repricing during this quarter, so there also we will be getting another 10 basis points. So that way the net we can expect that we may be 4 plus something like that for the next quarter. Now coming to the third and fourth quarter, it would be too difficult to estimate at this stage. Maybe next quarter when we come for the call, we will be able to have a fair view of the third and fourth quarter. So, but our intention is to the extent possible to maintain these yields. As I told you clearly, the low yielding, by getting out of those cases, also our yields are improving. Whichever way we need to protect our yields without losing on the quality. So we are working on that. We will see next quarter 4 we will try to maintain, and beyond that, how best we can maintain, we'll let you know.
Okay, sir. Thank you.
Thank you. Thank you, Pranav. Thank you.
Thank you. Ladies and gentlemen, if you wish to ask a question, please press star and 1. Our next question comes from the line of Sumit Balotia with MK Ventures. Please go ahead.
So congratulations for excellent set of numbers.
Thank you, Sumit. Thank you.
Yeah, so despite of the sharp NIM compression which was already guided, we've maintained very good ROAs. So the few questions that I had, I think a few of them are already answered. But if you can give more insight on the consumer banking division that you're expanding, and you made a comment that the hiring that you have done, benefit of that will be visible from second half. So if you can quantify that. So one is on what kind of benefit you're expecting in the second half on the deposit front. That is one. Second is more insights on the overall consumer banking division and the hiring that you are doing, how that is going to benefit us, say over the next couple of years. And also finally on the cost to income, how do you see that panning out?
Yeah.
For this year and the next year.
Thanks. So Sumit, in fact, all along I have been sharing what are the developments. Now that's the reason this time we have included Mr. Dolphy Jose, our head of consumer banking. So he'll brief what is happening there and what is the manpower, which are the segments they have started and all these things. The cost to income ratio is concerned, our CFO will respond for second question. Dolphy, over to you for the first part. Please brief the audience on this, please.
Yeah. Hi, Sumit. This is Dolphy. I will first take you through our plans for the liability piece. So broadly, we have classified our deposit mobilization into internal and external. Let me cover the internal part. Our largest franchise of the bank, which is our branch network, will continue to acquire new with more focus on deepening and enhancing the customer RV and product per customer. And our existing business banking verticals now have targeted deliveries to acquire and deepen current accounts. We also plan to increase low-resource light branch network simultaneously to increase footprint, especially in the semi-urban and the rural geographies. Also, apart from this, we are also opening digital banking units in tech parks and cyber cities. External plans are the go-to-market plans. This would, the internal covers mostly deepening enhancement and ETB customers. External is the go-to-market plans where we have formed a sales team where we have a feet on street for household and general public accounts for CASA and TD acquisition. We have a vertical called salary team which focuses on salaried customers, catering to salaried accounts, not specifically corporates, but mostly mid-sized corporates and large SMEs. Then we have sub-verticals for NR and fixed accounts. We have a separate vertical for government and institutional business. These are primarily focused prioritization plans. The P&FX vertical focuses on trade and current account execution. We have an existing BC partnership with close to around 100 BC points, which we will take it to about 450 to 500 BC points. And our attempt is to have 90% plus active BC points. We are confident to grow our deposit rate consistently as per the deposit growth guidance of the bank. On the retail asset side, as I mentioned earlier, branch banking continues to be our largest franchise for sourcing retail assets. Apart from that, we have two sub-verticals. One would be a vertical which will be aggregators for fulfillment of leads generated by the branch channel. That is called the branch channel sales team. And one separate vertical for open market who will primarily source from DSAs and business connects. These are two other verticals which are started under the retail assets segment. Apart from this, we are also relaunching the credit card co-branded approach, and we also intend to launch the open market gold loan, where we would go to market with a sales team who would go to market and acquire gold loan. These are ballpark. These are our plans for both RL and RL.
Yeah, Sumit, coming to any questions on this before we move to the cost to income for that, Sumit?
For this, sorry, just one thing on the consumer banking. So I understand the divisions, but do we have internal targets of, say, what kind of growth we would be targeting for this retail segment? So as of now, if I look at it, we have been going slightly higher than the overall system credit growth for the last, for a few years. So post this expansion that we would be doing, what kind of growth we would be targeting vis-a-vis the industry once the team is fully in place and all these verticals are fully functional?
Yeah, Sumit, in fact, I'll just share my point on this. Now you see, initially we have focused on the liability side, particularly for the CASA, so that it is going to help us in the low cost deposit. Though initially we may be investing some sort of a investment on that, but they will be mobilizing the assets as well as the cross-sell also. So it will take 1 year process for stabilizing, because these people, they have come from different banks. Their working is different. They need to get stabilized and they need to see different products and all. They need to get that. So our focus currently is on the CASA. Simultaneously, as Mr. Dolphy was mentioning, rest of them, few of them are in the pipeline, few of them, these direct selling agents and feet on street for the assets we started working. So it may take 3 to 6 months for stabilizing this entire thing for the working. But earlier, if you can look at it, we were struggling at around 4%, 5%, 6%, that way 8% also in respect of the consumer banking asset side. So, but if you can recollect, see the numbers now, more or less it has come up well, and this quarter also, quarter on quarter it is around 4%. Even if you annualize it, comes to 16%. So 18 minimum. So that way we have moved from 6-7% to 18% with the internal what all we have and some external what all we are taking and on. So that way we will see overall once it stabilizes, how we can do it between 18 and 20, we can see that. Because one more point I need to tell Sumit, the easier way for growing in the consumer segment is to go for the unsecured. Unsecured, if we go on doing and all, then comfortably we can grow at 25%. But if you can look at our portfolio, unsecured, that slide also if you see, that 600 crores what all is there and all, majority is coming from the BNPL program. That's why we have regrouped it, we have put it there. So, and not only that, few within the bank, whoever are there unsecured we have given, and this is our portfolio. We do not want to grow aggressively under the unsecured, that too under current state where many banks are growing with a much faster pace. So that's why unsecured, when we have kept it out, so we need to mellow down our expectations also on the growth around 18 to 20%. That's what we feel.
Understood, sir.
Yeah. Okay. Yeah. Regarding the cost to income on account of this initiative, our CFO will respond.
Yeah. Sumit, yeah, Ramshankar here.
the various initiatives which already it was mentioned in our opening remarks by our MD. One is that the RL sales acquisition, the other one is that QAB Smart, and a little bit in RA. All this put together, we expect around 10 basis points increase on our cost to assets on an overall basis. So this is, 10 basis will be actually, if you take into cost to income ratio, if you look at it, maybe initially 1 or 2 quarters it may go up, but however the productivity of these new channels will be there will be a time lag where we can get the income from that. So till that point there will be an increase, but however we hope that it will be compensated as done in last 2 quarters by a recovery from return of account. So overall, as we guided, it will be in the range between 45 to 50% levels.
So Sumit, in fact, this is as always I say, cholesterol, good cholesterol, bad cholesterol. This is a good cholesterol, which we need to spend this capital investment for the future. So that is the reason, though there can be a lag between what we are spending and what we are going to get. So that lag is quite useful because subsequently what we are going to get is perennial. So with that intention, we need to take the plunge, and we took it.
Thanks, I absolutely agree with you.
Thank you, Sumit. Thank you.
Thank you. Our next question comes from the line of Yuvraj Chaudhary with Anand Rathi. Please go ahead.
Good evening, sir. Thanks for the opportunity and congratulations on a good quarter.
Thank you, Yuvraj.
So could you throw some color on how the demand scenario in Tamil Nadu for various industries, specifically if you talk about textile industry?
Yeah, I'll tell you. Agreed. In fact, textile is one of our mainstay, and so now if you look at it, last 1.5 years, textile is undergoing some sort of a pain because both cotton price may be going up and yarn, all these issues, and the Europe issue, US issue, China issue, with all these things, the level of production in many of the plants has come down. So then because the demand is not there, particularly the apparel industry also, if you see in Tirupur, so their order book was more or less come to a more or less minimal last year. But when we are interacting with the players now, so the question is, China started importing the yarn once again because our yarn is one of the cheapest and the quality is good. So that way some sort of a demand started because for a few months, many months, China, there was a total lockdown and the activity was not there. So this is one way yarn, when it has come back, many of the spinning mills which are good and all, they are able to slowly get back. I am not saying full-fledged, full scale they will be able to do it. Now coming to the other side, apparel industry and other things, if you look at it, so because the shelves in Europe as well as US, our clients are concerned, majority of the exports are going to US. So when we interact with the teams and all, what we understand is slowly the demand from the US started coming up, and these apparel also, they started getting the orders now. But good thing if you look at it, so though this process is going on for the last 1.5 years, none of our clients actually, so we are able to face the stress because there are 2 reasons. One is they may be literally conservative initially itself, unlike many of them. When the lot of expansion was going on, these people, they didn't go for such sort of an expansion, and even if our clients have gone for expansion, they have gone for solar, which substitutes the EB power what all is there, which has saved them. So that way the term loan component and the interest component burden is not there for them. And second thing, because the orders are not there, many of them, the working capital limits have come down drastically, the utilization levels. So despite that, we are able to show a growth of 17%, though the working capital utilization is not there. So we are happy literally, though the working capital utilization is low, because when the orders are not there, working capital utilization is full, we will be terrified. So that way, the quality of the clients what we have for the textile, though the portfolio is high, till date 1.5 years we didn't had any problem that way and all. So we feel that while interacting with them, so maybe another 6 months this problem will be over and they will be able to back to normalcy, because the cotton prices are stabilizing now. Though on one side people say cotton production has come down and import duty, all these things are there, but whatever it is, price is getting stabilized at 50,000-55,000. So that gives some sort of a confidence to the people, because earlier people are thinking prices may come down further. That is the reason they were not buying the cotton and stocking it. Now that the stabilization is happening now, people started venturing buying the cotton. With that, the utilization levels will go up. With this, the production also will start. Otherwise, what all orders are there, on a just-in-time basis, they are buying the cotton and all, they are producing and they are exporting or selling. So that trend is going to change shortly. So this is broadly about the textile.
That was really helpful, sir. Thanks.
Thank you. Thank you.
Thank you. Ladies and gentlemen, if you wish to ask a question, please press star and 1. Our next question comes from the line of Renish with ICICI Bank. Please go ahead.
Yeah, hi sir. Just one question. Hi sir. So just one question on the gold loan portfolio, which is 25% of our book. So if you can just throw some light in terms of what is the tenure, what is the yield, and if you can share what kind of RoA you'll be making on the gold business.
Renish, in fact, if you can look at it, so some 1.5 years back, when I was asked what will be the gold loan portfolio of the total portfolio, I was indicating it can go up to 30%, but still we are maintaining it 25%. Okay, because other side also book is going up. Second thing I'll tell you, so there are few advantages what we are getting. When I'll talk about the yield also, but before that I want to talk about what are the advantages what we have. On one side, if you look at it, so absolutely totally backed by security. And second thing, if you look at our presentation, the LTV is 68%, leaving 32% for any unforeseen eventuality. So that way the chances of losing money is remote. And next thing is there is no capital adequacy and charge required on this. So there is no capital cost on this. And next thing is because majority of the portfolio is for the agriculture, it is covering for the priority sector. And that way wherever shortage is there for other banks, if I can sell the priority sector certificate, we will be able to get the PSLC commission also on this. So these are the various advantages by going for the gold loan. Now coming to the tenor, if you look at it, majority of the gold loans are for 1 year, 1 year or 2 years maximum, and it depends, it is linked to the cropping pattern. So for the crop what we are giving, it will be synchronized to that, and along with that we will give some sort of a time also for the repayment. The pricing ranges between 8.75 to 9%. That's how we will be getting it. So that way, it is no risk, no capital with the 68% with priority sector and 8.75 to 9%. We feel is a good yield. That is the reason we have gone into that.
Got it. So let's say the RoA in this business would be at around the blended level of 1.5, or it should be higher than that, because ideally there will be no credit cost.
It is slightly relatively higher than that. Because if pure RoA, if you look at it, it will be 1.5 plus. But if I take into account the capital cost what I am saving and the PSLC benefit what I am going to get in times of sell, if I add it, it will be adding as a kicker for that.
Got it, sir. And do you, let's say, since given these loans are, shorter tenure loans, and once, I'm saying the gold loans are, let's say, it's a shorter tenure loans, and hence when the unwinding happens, do you foresee any risk to the growth assumptions?
No, that is the reason if you look at it, the potential what all is there, our branches. So simple reason, because there are many competitors are there. Despite that, if you look at it, last YOY growth, it is around 2,500 crores growth has come. Maybe something to be aided by the pricing, gold price has gone up. Otherwise also number of loans and this is going up, because our people, they are good in giving a good turnaround time and the service. So that is really helping us to have a better this thing. Maybe over a period of time it may happen that way. That is the reason what we are doing currently is we started slowly diversifying into other activities. So what we did in our presentation we have shown, so other types of loans which are more or less with tie-ups and all. So we started growing, more or less 150 crores we have grown in this quarter, 100 crores it has come up. We will grow further. Likewise, to some extent that MFI loans also what we thought, on a smaller scale we started around 55 crores, something like that outstanding now. And there also with the checks and balances we are growing. Likewise, if you are focusing on the food processing where there is a lot of scope is available, that and so to some extent the poultry and dairy, these sort of things, that too with the tie-up. So these are the areas we are looking at it. Once we diversify and go into that one, then to some extent our dependence on this gold loan should come down over a period of time. That is our plan of action.
Got it, sir. This is very helpful, sir. Thank you.
Thank you. Thank you.
Thank you. Our next question comes from the line of Madhuchand with Macpro. Please go ahead.
Hi. Hi. Good afternoon, sir. My
Hi.
question is on RoA. I mean, so far it has seen a steady uptick, thanks to the expansion in margin and lower credit cost. Now that we are hitting a point where margins are going to head south for sure, we have already seen that in the quarter, and you're guiding to that, and the credit cost remains extremely benign. What are the kicker for RoA expansion, or should we expect RoA to stagnate from here on?
Ma'am, in fact, I agree. So margin expansion with all these things also, still we are able to maintain. If you look at the credit cost, so it may look like this at today, but with a 390 crore of net NPA on a 66,000, 67,000 crore book. So even if tomorrow we need to provide a lot also, we will not be able to provide for that. So that way, naturally, what all we are earning will be flowing into the RoA only. So that is one. And second thing is, if you can look at it, the initiative what Mr. Dolphy Jose has mentioned about, the liabilities CASA vertical what we are starting. So with that, if the cost of funds comes down, naturally that will also help us to improve our margin. It will be margin accretive if we are able to go for that. And next thing is regarding the other products under the personal banking. So where currently our focus is all on the mortgages, now we are trying to go for, to some extent, on the unsecured. For that, what our plan is, we have extensively gone for the BNPL with the Amazon program. In the process, lakhs of customers we have acquired. So it is only a monoliner under that, the BNPL only we are giving them. So what we discussed with our partner and we started doing is, what are the possibilities are there for co-lending these people for the personal loans? Because if a customer is there with us for 2 years and continuously has been servicing this Amazon loan continuously and other CIBIL scores, if you look at it, so we will have a fair view of these customers where we can go for that. Under that, the other partner, whoever is there, last 6 to 8 months, he started the program for co-lending, directly lending under personal loans to them, and it started very well, and all the recovery and repayments are pretty good. Now we are actively working with them either for the co-lending or for the pool purchase of the personal loan portfolio, which will help us, which will add to the margins of the retail portfolio. Likewise, our agriculture also, if you look at it, currently we have been doing only the majority of these gold loans. Now when we are moving into other areas of the agriculture where the margins are relatively better, and we have tied up with one of the prime players in the MFI sector, a business correspondent who is well versed with doing this one based out of Coimbatore, and he is there in the field for the last 11 years. And the MFI, when we started working there also the yields are relatively better. So that way, we are looking at various options where we can go for that. As it is, you know very well, our commercial banking where the yields are 9.5 to 10. Our focus area today also is commercial banking. For that, what we are doing, we are trying to benchmark our products as well as the processes with the market and all. If we can improve our commercial portfolio further, that will help us in overall yield. So next thing is we are focusing on the fee to assets. Fee to assets currently, the non-fund based what all is there, we are seriously working on that and how to improve that so that we will be able to get that. We have strengthened our cross-selling vertical. We have taken from the market a set of people and we have engaged many people. Now we are working on how to offer many more products to our customers, that way improving the cross-sell income. I can say that compared to last year, this year our income under the cross-selling is more or less doubling. So we have a lot of scope for that. So that way every lever what all is available for us to improve the income side both on the fee as well as the interest, we are working on that. With these things, our endeavor is to see that the 1.5 what we have reached, it has to be above that always and all. Whatever is possible, we will try to take it forward by pushing every lever.
So you mentioned all the revenue income side, but you didn't mention anything on the cost side. So should we assume that?
Okay, I'll share that also. And in fact, if you look at the cost side, there are two main aspects are there. One is the establishment cost, second is other expenses. If I look at the other expenses, the earlier numbers at this, the progression is more or less the inflation linked. What all inflation is there, more or less the same way it is moving, nothing much. Coming to the establishment part, if you look at it, you must be knowing that last 3-4 years back, these started taking many people from the market. All of them are the CTC based who are linked to the performance as well as the variable pay that way. So that way, we have a better flexibility, better productivity. We may be paying something more, but we will be able to get the better productivity. If you can look at the slide of the presentation, what you have. So last 2020, it was 3 profit per employee. Now it is 17. More or less, the set of staff members in the bank, whoever are there, the same level of 8,000 number ballpark here and there we are maintaining that, whereas the profit per employee has moved from 3 to 17. So that way we are trying to control the cost. I agree our cost to assets is around 2.5, 2.6 running. We will try to bring it down to 2.5. 2.5 currently is there. We are also planning to see which are the areas where we can bring it down. But let me be frank on one point. Suppose if I am a miser in respect of incurring a cost and tomorrow I may be missing an opportunity for getting a great business in that. That is the reason we have invested a lot on the liability verticals in the smart and other verticals also. It may look a cost now, but it is going to be a money spinner tomorrow. So that is the reason, keeping all these things in mind, our focus is majority on how to earn more on the income side rather than giving a total focus on the cost, though we will focus on that ratio.
Thank you, sir. So, what is the 3-year aspiration as far as ROA is concerned?
Aspiration for the ROA or... I'm sorry, which one you are talking about?
Yes.
Aspiration about ROA?
I'm saying, yes, in 3 years' time, 3 years down the line.
3 years is a very long period. At least nowadays, 3 quarters is
but you are planning for it,
things
right?
are moving. No, ma'am. In fact, I'll tell you, you must be seeing, you must be tracking this also. 3 years back, we were at 0.33, something like that. At that time, we never imagined that our ROA will reach this sort of a number. We have reached this. One more point also for the benefit of the entire audience I'll share. We started looking at our last 13 years numbers, the annual growth, barring 2 years where in 2011 and 12, we were aggressively growing in the corporate. Those years, the annual growth was 12,000 crore. Otherwise, the rest of the year, the total business growth was around 7,000, 8,000 crore. If you can look at our first quarter growth, annual growth for the 8 years, 9 years, what we were getting it, we are able to get it in 1 quarter this year. 6,786 crores is the growth in the first quarter. So with the tempo what we have brought, though ROA we will try for between 1.5, 1.75, whatever it is, because we will not stop our efforts there. The growth in the business what we are bringing, and that too, the difference between the earlier portfolio and current portfolio is, now it is a granular portfolio. If you can look at it, the corporate consciously we have brought it down, number of below 125, and the majority of the portfolio is secured. If we look at the unsecured portfolio of the bank, it is 1.85%, which is below 2%. With all these things, we feel, so we will not be below 1.5, and whichever we will take it forward and all, our endeavor will be there to take it forward, ma'am.
Thank you, sir. Thanks a lot and all the best.
Thank you, ma'am. Thank you.
Thank you. Our next question comes from the line of Jay Mundra with ICICI Securities. Please go ahead.
Hi, Jay.
Yeah, hi, sir. Thanks for the opportunity, sir. I wanted to check on employee count. Last time we had said that, we want to step on employee, we were hiring a few employees after long. So how has been the employee count as of 1Q end? And is the majority of the hiring has already been done, or it should continue for the next 9 months as well?
Jay, actually the count as of 30th June is 7,900. But as far as the liability business is concerned, still we are on the job. And already our MD has indicated how many numbers what we have done. So for example, we have planned 1,300 resources. So of each 905 resources already onboarded. And during this quarter, we have onboarded 425.
Right. Okay. Right. Sure, sir. And on SA savings account balances, right? So we are doing a lot of efforts on savings account in institutional side, but the total SA growth has been very soft, right? So it is an industry-wide phenomena also that across banks the SA growth has been much muted. But two questions: how do you see SA growth panning out, and B, do you envisage any tweak in the SA rate also to show the savings account balances?
Second question I'll respond, and first question I'll give it to Dolphy. So, Jay, in fact, earlier also when we looked at it, the change or hike in the interest rate didn't materially brought many inflows into the book. But the downside is this rate would be going for the existing base also, in that overall the cost is going up. The cost we are going to incur and the benefit we are going to get, it is not commensurate. That is the reason we held it. But whatever it is, we will also look into that one, because a set of people from the market, they are there continuously studying the pulse of the market, what we need to do. If at all that situation comes, we will gauge the cost benefit and we will do that. Coming to the first question, Dolphy, will you take that question, please?
Yeah, Jay, Dolphy here. So whatever I mentioned on the go-to-market plan or from the sales team angle, these are all exclusive teams catering specifically to SA acquisition. When I say salary team, when I say NR, Prestige, institutional business like government business, etc., all are specifically towards SA. Now, all these activities, I mean, as our president mentioned that, already about 900 odd people are onboarded and they are active. All this is going to be incremental SA acquisition. So I agree that at industry level, SA has been muted. So being a part of the industry, we also have to face that. But our go-to-market strategy is what we discussed, and that will definitely get an incremental SA.
One more point also, Jay, if you can see that, so SA would have gone up, agreed. But consciously, our own staff also, they discussed with the customers, and wherever to some extent customers are risk averse, and where they are susceptible to move to other banks for a time deposit. So we converted them into time deposits so that we can retain the deposit with us and relationship with us. So that way, to some extent, the growth in the time deposit, 20% we have come. It is something is organic, something is actually driven by our own teams. So we thought relationship and retaining is important, and otherwise some other bank will take them out and down. We will not be missing that. We will be missing that relationship. There is another reason also for reduction in the SA and growth in the time deposits.
Also, can I just tell you something?
Please.
For our SA customers specifically, we are coming with an array of products as in form of third-party products. For example, we are going to aggressively start marketing SIP, where we ensure that the SA balances are maintained if there is a cyclical SIP. So these are things which we are looking at and trying to ensure that the deepening on SA happens. And from bulk SA point of view, where we are looking at government business and institutional business, where we are looking at getting SA balances from autonomous concerns like corporations and civil bodies and state bodies. That's the broad plan for SA, bulk as well as retail and digital.
Yeah, so my limited point is, sir, these institutional balances, they are supposed to be interest sensitive, right? Rate sensitive. So how do you intend to chase or attract those deposits when we are, let's say, not in the top quartile when it comes to offering the rates?
Yeah, our rates are relatively better. In fact, they are quite competitive, Jay. But Dolphy, you can respond on that, please.
Yeah. So when I say bulk, I mean, there is a segment where we can actually operate at slightly higher rates, where it is not retail, and still get a decent impact on our overall stock cost. So that's our plan. And so there are some slabs where at a very example 100 crores plus kind of slab, where we can get into a SAR distribution risk, and we will probably proceed in that direction. And on the retail side, if you look at the smaller SAR accounts, again ranging from 10 to 25 crores, it's mostly, if it is institution, especially institution, it is relationship, and it is RM-driven business where the relationship is quite intense and engaged. And there we intend to integrate these not departments, these autonomous concerns on a solution basis and offer solutions to make sure that the SAR balances remain with us. That's the plan.
Right. Okay. And sir, on your term deposits, right? So if you can briefly comment that, how much proportion of the term deposits would have repriced. I hear you saying that, next quarter also cost of deposit is going to go up. But a rough calculation that, at least what proportion of the term deposit would have repriced?
I have seen the numbers, Jay. On an average, around 2,000 crores it is repriced. So that is the usual run rate for the time deposits to reprice.
Sorry, 2,000 crore you said?
Yeah. So a few months 1,800, few months 2,400. That range they are getting repriced. So this is the range our people they have taken into account also. They also seen earlier the repricing what all is happening. They are going into which buckets. Luckily now we have reduced the rate of interest also. So that it lands there. With all these things, now to be frank enough, in the month of this April, when we did some sort of a homework how the prices will move. So what all we thought is 30-35. So we thought by July ending it will come, but it has come in June. So that way, what all we have planned more or less on track, this movement of the cost is going on. So with that only we thought that it may go up by another 20 basis points. That's what we thought.
Right. Okay. Sure. And lastly, sir, you have created a 25 crore floating provisions. Any thought process as to, of course the credit cycle has been very good, but if any thought process on, is this some policy driven, you want to achieve a certain percentage of standard assets in terms of floating, or this could be one-off kind of a thing?
No, I really agree. It is a policy driven. Board has approved a policy also for this purpose. So we thought of going for this. Now they understand that when good times are there, we need to have some sort of a buffer for any bad times somewhere comes, which we cannot visualize. That is the reason we thought that let us do this. Now, if you look at it, on one side, RBI, they have released an approach paper for the expected credit loss, ECL was there. And now maybe 1 year or whatever it is, this may come up and all. So we do not know, unknowns are there, how it pans out and all, how much we may have to do it. All these things are not known. So that is the reason what we thought, instead of having a sudden shock at the material time. So if we can start creating some sort of a buffer from this stage, at that time we can utilize that by taking the approval from Reserve Bank of India, which will not alter the equilibrium what we are continuing for the normal trend. So this is the basic intention. Otherwise also if you can look at it, so this is not going to get wasted. It will be a part of the Tier 2 capital. So Tier 2 capital, when it is going there, is indirectly supporting us for our growth also.
Right. But sir, if I look at your SMA 1 plus 2, right, they are very benign and it looks like they are the industry lowest, right? So when KVB has to shift from, let's say, Indian GAAP to IRAC to Ind AS, the impact should not be material, right? Because you have the SMA 1-2 is actually few basis point only, right? It's less than 50-60 basis.
I agree with you, Jai. The question is, what you think is SMA 1 and I think the NPS currently, and I may think the LGD what all is there on account of PD. But only these things will play around and finally the ECL guidelines will come or something else will come. We do not know at this stage. Once we have an absolute clarity, then absolutely we need not place it also. Till such time we have a clarity, we thought of doing this one. so that we are reasonably assured of our position or the continuity in future. That's it.
Right. Understood. Sir, and last data keeping question, sir, what is the recovery from TWO account in this quarter?
58 crores we have got it. So last year first quarter was not there. Now from first quarter onward we started getting it. 58 crores we have got it.
Sure.
Last call, Kotak Mahesh was asking, saying that whether we will be able to get that much of amount what we have got for the last year. So more or less we are working on that to far surpass last year recovery what we have got on the recovery.
Right. I mean, see, your PCR is 93-94%, right? On including TWO.
Correct.
So ideally that should help.
Correct.
So great, sir. Thank you so much, and congratulations also on the reappointment, sir.
Oh, thank you, Jay. Thank you. Thanks for the good wishes. Thank you.
Thank you. Our next question comes from the line of Akshay Gupta with Investec Capital. Please go ahead.
Yeah, hi sir. Thank you for my question. Taking your questions. Hello, can you hear me?
Yeah, please. Akshay, I agree, but some sort of an echo is there. If something else you can do it, nothing great. Otherwise, you continue.
Yeah. So, sir, I have two questions regarding. So, what's your NII growth guidance for FY24? Like, we already given a guidance for advances and deposits. So, what's your view on the NII growth?
You are talking about net interest income?
Yes, for FY24 guidance.
Agreed. FY24, Akshay, I may not be able to give at this stage. You see, we are at 3.8, something like that we were running. So, 3.84 currently for the quarter ending if you look at it. So, that way, overall RoA, we are planning for 1.5. If suppose NII some issue is there, we may be trying to make it up in the fee to assets or in the cost or the credit cost, whichever way, the overall math, what all is there, will work on that. And we will be above 1.5, that is our intention. So, because we do not know how these cost of deposit pans out and the yield. Because yield, if you can see that, last year October our MCLR has changed. And after that, so we started doing this. Up to October you will get the benefit. And last MCLR change was in February. So up to this February we will be getting some sort of tickle, some sort of a growth in the fee income, interest income will be there. So with what all I have told earlier for the fee income what we are working, that also should help us, even if there is some amount of shortfall here and there in the net interest income. So we may be able to make it up in the fee to income. That way overall we will try to balance it. But I can say that the RoA is a key factor where we are monitoring overall how to deliver. Then internal what all is there here and there, some adjustments will be there where we will be able to manage.
Okay. And so, one second question I have, like in the current quarter, why we have reissued historical balance sheet?
Sorry? What is historical balance sheet?
My question.
No, we have given the second page of the interest accrued but not due. As per the RBI disclosure norms, we have reclassified it. It was done in March, so according next to 1 year, this adjustment will be there. Because we have to the comparative figures also we have to realign it. So that's why there is a realignment in the figure.
Okay. Thank you, sir.
Thank you. Our next question comes from the line of Rakesh Kumar with BNK Securities. Please go ahead.
Yeah, hi sir.
Hi.
Very good set of numbers in this quarter. So
Thank you.
Quite splendid performance. So just on the we had a quite good discussion on deposit side, but just to slightly understand it, the TD cost increase has been there in the system and for us also. So, like any specific reason that TD cost upward revision on the calculated basis on a quarterly average balances, that number has been slightly on a higher side. So, how do we see it and going ahead?
See, as you already mentioned, the TD cost, because of the special deposits which we had launched in February, March, had a little impact. Now, in fact, we have already taken steps to, with the surplus liquidity what we find in the system. We have reduced the special deposit rates by 20 basis points already in the for our existing products. So we don't think we'll have a major. Even similar lines it will go on for the next 2 or 3 quarters.
Okay. So out of the total TD, like as per the ALM that we have, like what percentage would be like would be remaining to reprice? I joined late. Actually, there was another call going on. So
I'll tell you. In fact, I have to clarify. In fact, we have seen our data. So on an average, if you look at it in the next quarter, around 25% or 23% of the TD will be maturing. I was telling at that time around 2,000 crores on an average. So it is ranging between 4 to 4,500 crores, and subsequently third quarter onwards, it is coming to 2,000 crores. So that way around 23% will be repriced in the next quarter, September quarter, and after that it will come down to around 12-13%.
Rakesh, see one more point here. Initially, when that deposit rates was hiked, there was a lot of pre-closures were there. So what we are noticing is that almost it's all stopped now. So that is why we are indicating the coming quarters, the increase will be slightly lower than whatever we have done in this quarter and the earlier quarter.
Okay. Got it, sir. And the credit movement, so because right now there is no change taking place on the, like on the EBLR side. So whatever change that we have is on the MCLR side. So how do we manage, the increase in the credit yield, because TD cost is rising. So how do we manage that? So what are the tools that we have in mind for that?
Yeah. There are two to three tools which we can think of. One is, as we said, because our MCLR is around 47%, though 10% it has moved EBLR and this way. So that way up to February, we will be able to get some benefit on account of the MCLR pricing. And second thing, I also told you about few of the products which we are working on that. So where actually our yields may be relatively better. And third thing, the CASA vertical where we are working, that may overall reduce the cost of deposits. The TD may be there, the CASA portion other side goes up, it may reduce. And fourth thing what we are saying is, we are critically looking at our portfolio, depending upon the rating of and other weaknesses what all are there, have we correctly priced it or not? If it needs to be repriced, we are engaging with the borrowers to modify and revise the pricing so that the yields will improve. All these what all are aside, simultaneously we are working on that to see that what best we can get out of the yields.
So, Rakesh, in addition to that, if you notice our yield on investments, continuously for the past 6 or 7 quarters, it is increasing because when the yields are bottomed out, we went for a short dated. Now we're converting everything into the long dated securities. So that is also giving a support. We have given the guidance of 10 more basis points increase in the coming quarters on the yield on investment.
Thank you. Our next question comes from the line of Lakshmi Narayan with Tunga Investment. Please go ahead.
Yeah, thank you for taking the question. 2 questions I have. First, in terms of your attrition at clerical and above clerical, what is it approximately?
I think exact percentage I will not be able to tell you, but one thing I'll tell you, compared to last year, last 6 months, 8 months, the attrition has come down. The reason is simple. Last year, a few of the public sector banks, so they offered a local posting where the nearer to the native place, something like that. That is the reason some sort of an attrition is there. But compared to that, the attrition levels have come down this year. I think the exact number I may not be able to tell you, Mr. Lakshman, now.
It is actually for a clerical, normally there is no much attrition. Only in the officers level, it is 5 to 7% is the average.
Fair enough. The second question is regarding, the commercial advances. I believe, you mentioned that everything is secured advances. Now, within commercial, what is the split between the micro, small, and medium? Because you have mentioned that 69% of your advances is less than 5 crore. So if you can just expand that a bit and say how much is the micro, how much is small, and how much is medium, and I mean what kind of stress level you are seeing, whether the stress is actually now it's passé, because we hear that there is still some stress in that MSME space. So if you can just elaborate, it will be helpful.
Achha, before that, Lakshman, I got the number of the attrition rate. From April to June, it is 1.22%.
Okay.
So, Amshit, anything you can tell about the MSME? Otherwise, Lakshman, in fact, we'll do one thing. Our CFO will engage with you and he'll provide you separately.
See, we have provided our SME 1 and 2 30 plus data. So, including all sectors, it is less than 1%. So we don't see any.
No. My question is slightly different. So it's about the micro enterprises, medium enterprises, and small enterprises. Do you see stress in that thing? And how do you split? Because you give a single number on commercial. Just want to do a little bit granular. And is that do you find stress in the micro enterprises or small enterprises or medium enterprises?
Okay, we'll keep in touch.
Yeah. So please, we'll provide that. Thank you.
Okay, so just one other question. Yeah. So, do you see any risk of balance transfer in or transfer out? Do you see in your commercial book?
It will be there in every vertical. Okay.
As it
retail as well as commercial, balance transfers will be there. Likewise, we also have many inward balance transfers are also there for us.
Now, are you seeing a spike or
No, spike is not there. I'll tell you. This was peak during COVID and post-COVID to some extent. At that time, few banks, what they were doing, they were either cutting the pricing what all is there, or they were reducing the collateral drastically, or they were revising the value of the collateral what all is there, and they were taking giving a higher exposure. We didn't resort to all those things at that time. If anyone were coming and all, if the risk-reward pricing is not there for us, we were leaving it. Now the position has come under absolute control. If at all we are leaving the account something like that and all, consciously instigated by us where the quality is not good, we have told. Otherwise, that earlier set of poaching, it has come down now and all. Absolutely, there is semblance in the market now.
So thank you. One last question, sir. In terms of your advances growth particularly in commercial retail, how much of your incremental advances are coming from existing borrowers and how much is coming from new borrowers? Is it like 2/3, 1/3, or is it like half?
No, I will tell you, ETB is concerned, agreed, maybe around 60% is coming from NTB, I can say. The reason is, you see, if the capital expansion is not there and the utilizations are not there, and many times even the textile what we have, the utilizations are coming down day by day. So that way the working capital limits are coming down and the existing players are not using, the customers are not taking any fresh term loans also for the expansion. So that way majority of the growth is coming NTB is from the NTB only, and it is more or less 60% you can think of.
Okay. Thank you so much.
Thank you. Yeah.
Thank you. Our next question comes from the line of Meet Jazane with Jazane Investments. Please go ahead.
Yeah. Hello, sir. First of all, very congratulations for the good set of numbers.
Thank you. Thank you very much,
I just want to understand on our co-lending model, like if you can share some granular details, like what is the structure, what role we play and what role they play, it will be very helpful.
Yeah. Meet, actually, as far as the co-lending is concerned, currently our bank has a relationship with 3 NBFCs. And number one is the Cholamandalam. For Cholamandalam, we do co-lending business for the construction equipments and commercial vehicles. So this arrangement is there for the past 2 years and working well. And number 2 is there is another NBFC called Axio, where we are doing a BNPL program for the Amazon checkout finance. That also we have been doing this business for the past 2.5 years, and it's so far our performance is well. And third is the IAFL, where we are doing for the gold jewel loan business. We just started during the last quarter. It is progressing well. In addition to that, another couple of NBFCs where we are creating the technical support and all. Probably in the next quarter, we will have will give some news about it.
Okay. So in this, they basically acquire the customer and give to us, and we just lend them.
Yeah, in this case, the co-lending model, normally it's 80-20, where 80 is bank's book and 20 is with the NBFC. End-to-end work is done by the NBFC, starting from the sourcing, operations, collections, everything is done by them.
But Mr. Meet, you need to understand one point. They cannot source something, the riffraff, what all going on the road and all, they cannot push it to us. Both the partners initially itself will sit together. They will finalize a criteria and parameters on which the borrower has to be sourced. If that borrower is meeting those standards, then only they can originate. Once it comes from their system, our system also does a checks and balances, looks at it. If it is meeting that criteria, then only it allows our system to enter into that one and to release our amount. If it is not fitting into those criteria, it will be rejected straight at that particular point of time. We will not even entertain that. This is one point. And second thing is, periodically we will be checking the portfolio, how it is running and all. That also will have a check and balance on that.
Understood. Got it. Thank you. Thank you very much.
Thank you very much. Thank you.
Yeah.
Thank you. As there are no further questions from the participants, I now hand the conference over to Mr. B. Ramesh Babu, MD and CEO, for closing comments.
So, I once again thank each one of you for your patience and the interest you have in Karur Vysya Bank and the questions what are you have are very informative. I once again thank and seek the support of every one of you for taking the bank forward. Thank you very much once again, and good day to all of you. Thank you.
Thank you. On behalf of the Karur Vysya Bank, that concludes this conference. Thank you for joining us. You may now disconnect your lines.